So let's take a look at this presentation of entry here and running to this very easy low-hanging fruit objective. Okay, I don't need it to go all the way back to here. I don't need to go to here. I don't need to go all the way back to the 7 o'clock reset on the liquidity for that pre-market session hour. So 7 o'clock in the morning to 9:30, that 90-minute window. We're spanning from the 9:30 opening bell back to 7 o'clock. Where is the pools of liquidity? If you target those, you don't need anything else in ICT's repertoire. You don't need anything else. You don't need new week opening gaps. You don't need new day opening gaps. You don't need any of this stuff except for just knowing where price is at right now and where it's likely to draw to. If you have an opening range gap, which in this case was a gap lower, so that means it's likely to do what initially? Try to make an attempt to move up into that gap. I'm not going to show you the relative. I'm not going to show you the regular trading hours to show that gap. You can do that on your own, but it's likely to do what at the opening bell? Open here and then draw up. Now, does it need to fill the gap entirely? No. Does it need to go to the lower quadrant? No. Does it need to go to consequent encroachment? No. But an attempt at all is, within the realm of reasonable. So if it's going to make an attempt to do that, doesn't it make sense inside the scope of 9:30 to 7 o'clock in the morning? Where is the easiest low-hanging fruit first presentation of relative equal highs? Right there. Okay. Now I'm going to hover over top of both of these arrows so you can see the execution placement. But here's the liquidity. After taking this larger pool of sell side, there, and there at the opening bell. So I'm watching this candle. It opens, trades below these two equal lows. And as soon as it trades back up into this area here, I know what it's doing. It's going to flip over and run at the very minimum here. Now, at worst, it could have went just above here and then came back in and filled in or given institutional order flow entry drill on any fair value gap from that low up to that point. But here it just rips higher, uses it as a breaker here, leaves that little portion open, breakaway gap, runs up and gives me the run into the relative equal highs. Trades just above this high here, which are relative equal highs as well. Now, why did I pick this one and not that one? Because this is the first one you come to at opening bell at 9:30 opening. Start looking to the left. Where's the first relative equal highs? They pop off right here. If you were looking at a 15-second chart, it would be here. But that's not enough for me to take the trade. It's not enough of a reward for the risk. Because I could have been wrong. I could have got stopped out, and you would have saw it. I would have showed it. But the stop goes immediately right below this by one tick. So buying, stop here, target here. There's a little entry caret symbol that shows you where my entry was on this candlestick. And now I'm going to hover over top of this one here, and you'll see that it shows me exiting the long trade here at that level there. And it spends a little bit of time right there and then folds and goes right down to that daily bullish fair value gap. It creates a low one more time to stop anybody out to try to chase that, and then rallied up. Now I'm going to teach you, as I mentioned in the presentation on Kit's space, and all you got to do is go to X. Okay, I know some of you are going to be watching this, years from now, and be like, "What are you talking about? What are you talking about?" I mentioned how, because I had students asking me direct. We had basically a couple minutes time for individuals to talk to me. And this is also, as a reminder, this is why I don't like to do question and answer, because I understand a lot of you think I'm a celebrity, like you think I'm something special. I'm not. And whenever I have an opportunity to speak with someone or give that opportunity to give the students the time to speak with me, there's this big monologue of lavishness and like fluffing me up. And I understand why you're doing it, but it's not necessary. I mean, a simple little post to me, on a comment in a video or post to X is sufficient enough. Like you don't need to go on and on and on. First of all, it's embarrassing because I don't feel comfortable receiving that kind of stuff. You want to thank and give praise, give it to God, but it also is annoying to the other listeners because they're listening to what you're asking and they want to hear what I'm going to respond with. So that's the meat of why we're having a conversation or a question and answer anyway. So that's the number one reason why I don't like to do those types of things, because it's a big time waster and it looks like hero worship, and I'm not a hero. So, but I mentioned, one of the students mentioned how they like to see certain things in a certain pattern form, whatnot. Well, whenever there's a pool of liquidity that's taken, okay, and it forms with a breaker, as we see here, we have a low, high, and then it runs to take this low out here into a larger pool of liquidity. This point of liquidity below that low here, inside that daily bullish fair value gap, that is where this leg of the breaker, if you look inside this leg, you'll see a fair value gap. Now, this fair value gap here, you want to start looking, going back. Where's the first one you come to? It's this one right here. You got to use the volume imbalance. This specific fair value gap is labeled by my PD arrays as the gauntlet. Okay, it's a gauntlet. That means you're laying down the gauntlet. I'm going to go long on the belief that this low has taken out sufficient liquidity, and then it should go higher to reach into this level here where there would be a breaker. You can use it as a breaker entry. There's lots of times where I use this as a mechanism for turtle soup. You'll never see this methodology explained in Linda Raschke and Larry Connor's book, and no other goober that's claiming to be the author of Turtle Soup ever done anything like this either. Oh, these goobers. So what we're going to do is we're going to highlight that right there. Okay, so this is the gauntlet. It's a very specific fair value gap inside of a price run of a bullish breaker. So it's the very lowest first sell side imbalance, buy side inefficiency. It has to be the SIBI. Okay, so when it's bullish, and you reverse this when it's a bearish breaker. It's the price leg that runs to the liquidity. The very first, going from the low back, that's the very first SIBI you come to. This is what you're looking for. When it raids above it and it comes back down in, there's your entry. This is your adding to it. Go back and look at some of the examples I did on, because a lot of you have them archived and keep them for, I guess, collection purposes. But even my executions on X, I've done this many times, many times. And it's always been coupled with people leaving comments. How did you know? How did you know to use that? Why did you use that fair value? I'm teaching it right now. This is just one of those 81 things where there's specific fair value gaps. As I mentioned, there's a lot of people that are writing books right now, and they're saying this is smart money concepts. They're omitting my name. They're not even mentioning the fact that they learned it from me. On X, I'm sorry, not on X, but on Amazon, and they're writing their little books and whatnot, trying to get their credit cards paid off because they've been charging up these prop firm accounts and blowing them. So you don't know what fair value gap you're looking at, but I promise you someone's going to rush to get this in print, and so I'm going to leave some of the details out. But trust me, this is the gauntlet. This is one very specific fair value gap that is pertinent to how you can engage price action, and using the levels here after it leaves the lower half. See what it does? Trades to it here. The body's staying above it, and then gives you one more time to add to it or enter if you missed it back here. If you did not utilize this, for the folks that say my silver bullet doesn't work anymore, I want you to think about how this drop down in here, isn't that part of the upper quadrant, or the upper half rather? Isn't this right here, this whole mechanism of using a SIBI going into an inversion fair value gap? That's what this is. That's a silver bullet. But I'm highlighting these quadrant levels here, and now I want you to look at this price level right up here. Okay, we're going to show you who knows what, and we're going to also show you what the signature is with the algorithm. If I highlight and hover over top of this very candle right here, which is what I'm doing, I'm screenshotting it when it's me hovering over the 7 minutes after 10 candle on the 1 minute chart. That low comes in at 19,784.25. That's what's being highlighted here. The upper quadrant of this very specific, with the volume imbalance, that upper quadrant comes in at 19,074.25. Boom. That's perfect, folks. Linda Raschke can't teach that. Larry Connors couldn't teach it. Wyckoff didn't know anything about it. Supply and demand? Nope. Elliott Wave? Nope. Sorry, no pitchforks here. Sorry, but that's perfect. That's an algorithmic price delivery signature, proving to you that the buying and selling pressure did not just agree to stop right there and agree and say that's the lowest this candle's going to go and it's going to go higher from there. It takes more faith to believe than that than it is that the market's rigged and it's controlled and it's going to a very specific level, stopping and turning on a dime, going higher. Why didn't it want to go down below this low? Why didn't it want to go down to the midpoint of it again? Why didn't it just roll over entirely? Because it's scripted. It's also occurring during a very specific time of day. I'm going to go in closer and zoom in on this. But I want to show you here is the buy side and balance, sell side inefficiencies. Here is your silver bullet. Forget the gauntlet. Forget that, okay, for now. But there's going to be people putting them in their YouTube videos now. That's good. It's good. It's good. The buy side and balance, sell side inefficiency here, that's your silver bullet. And this is institutional order flow entry drill right there. And that price running higher tells you that we're moving higher. But this candlestick right here, what I did with Thursday of last week's daily premium wick, we're going to do the same thing right here. We're going to look at this wick here. Let me zoom in. Here's that wick right here. Okay. And we're going to take the levels of the high, the upper quadrant, consequent encroachment, lower quadrant, and the low, which is the close of the candlestick right there. And we're going to project them forward. Okay. So again, this is going to slap the faces in the mouth of everybody saying that I rebranded this, that, and the other thing. Garbage. Garbage excuses for them being envious. Okay. And again, if it was beforehand, before I ever talked about it, why has it never been shown in people's examples? And why are they using my vocabulary? Why are they using my vocabulary? Because I'm the only one, Daddy. So if you take those levels and project them forward, you can see those specific levels here. And now we're going to, inside this range from this candlestick's close to this candlestick's run higher, I'm going to take you down into a 15-second chart. Okay, and inside this little range here, this is all you need. When you know you're on side, that means the market's done enough down here during the macro. So at 950 to 1010, that's what this is delineating here. Market drips down into the daily bullish fair value gap. Remember that yellow area on the daily chart I started with? Then it rips higher. We have a shift in market structure here. Silver bullet, institutional order flow entry drill. And then we have this wick in here. We have the gauntlet. We have the turtle soup, low to low. Okay, you shift in market structure. We have this wick's consequent encroachment, bam. See how all these details are like, converging. It's a confluence of multiple factors suggesting that it's done and it's going to go higher. So let's look inside this little range here on a 15-second chart. This is that 15-second area in here, okay? And before I go into detail here, I want to show you what I was seeing on the 15-second chart, because as I mentioned, every time I talk about executions, I'm looking at a 15-second chart, folks, okay? Just because you don't see it doesn't mean I'm not looking at it. If you look over here, when that dropped down at 930's candle, I'm entering right inside that. So as it reclaimed bullish fair value gap, relative equal lows, it just stabbed below that. And then when we're here, I'm going long while we're inside that. And the stop loss can be right below there. And this right here, this wick, you can break that down into the quadrants, and stop loss has to be at least below the low. And the market comes down to about the lower quadrant and then rips higher and goes to my target up here, as I mentioned when we were on the 1-minute chart. But over here on the 15-second chart, you can see that that range has fair value gap and volume imbalance. The market trades up, the bodies are staying inside that range, and then drops down, the bodies stay inside the lower quadrant, wicks down into the volume imbalance, but the bodies are staying inside of that buy side imbalance, sell side inefficiency. And then it rips higher for this pool of liquidity right there. Remember I told you, start looking at the 15-second chart, find the relative equal highs and lows and what time they run to them, okay? The price run begins inside the macro, time to here. All this looks crazy now, doesn't it? It's a 15-second chart. And look how clean the price action is. It didn't look that clean so much on the 1-minute chart. But when you know the bias, and you know the narrative, how it's going to employ the daily range at certain points and turns at time, everything becomes much, much clearer. And that's this area over here. And in the afternoon, I did a 1-for-1 risk. Took some of the profit that was over here, risked it here, and then added to it here for sell side there, and there you go. So with the positions from Monday morning, Monday afternoon, and then Tuesday's morning and Tuesday's afternoon, it's 103,000. Notice how we ran up into the first percent fair value gap on Monday. Wow, didn't it? And now, scrubbing on over here. Wednesday's consequent encroachment of the wick, lower quadrant, low. We trade down into it. Look at this crazy price run right up to Thursday's high on that wick. Isn't that crazy? Show you real quick. I'll move it out of the way, but keep your eye on over there. See all these executions. Right here. Same account, basically. And then now, this is Monday's first percent fair value gap. Pretty random, isn't it? Here. Thursday's premium wick high. This is the low of the wick. Lower quadrant of it, consequent encroachment of it, upper quadrant of it, and the high of it. Like that. They've worked a lot of the upper half. They dip down below it here, right back up in the Monday's or the week's first percent fair value gap here, and then we broke lower. So with FOMC later today, it's basically you want to stay away from it. Okay, let's say it that way.